wood alternative deck manufacturer Trex stock has been on an absolute tear. It's up 63% so far this year. Still well down from its previous all-time high, but if you look at it as a long-term investment, it has been a huge winner. But there's a lot of questions right now. Is this a time to buy? Is this really a good time to get in on this winner? Is it too late? Should investors stay on the sidelines? I'm Jason Hall. This is The Smattering. I've got Tyler Crow here with me, and we're going to try to answer the question whether or not Trex is a stock that's worth buying right now. Before we do that, we've got a great way for you to get 10 more great stock ideas. The Motley Fool sponsors our videos. We have a special link. Go to that link, fool.com/The Smattering, and the Fool is going to give you its 10 best stocks to buy right now. Be sure to check out that link. How's it going, Tyler Crow?
I thought I'd get some weird title like decking consultant or something like that. A nice boring intro today.
I give you the weird, obscure ones when we're talking about weird, obscure questions. And this one has a product in Home Depot, and it's the brand that is the industry. So no weird titles.
Yes, the common theme of composite decking.
You're just Tyler Crow today. All right, enough of that goofiness. Let's talk about Trex. So again, the stock is up more than 60% so far this year. The housing industry is still a bit of a mess. The vast majority of Trex's business is homeowners who need to build a deck or they need to resurface an existing deck. They want something better than wood, something that's going to last longer, doesn't have to have all the maintenance, maybe a little bit of environmental friendliness to it. And that's Trex. 95% is waste plastic that would probably go into a landfill, and scrap wood that they source from wood products manufacturers, and they use that to make the decking that lasts 25 years. All of that to be said, Tyler, what's going on with Trex and what do you see?
Like you said, stock is up quite a bit this year, and to a point where it's a pretty rich valuation. So you really have to justify saying this thing is going to grow at a pretty impressive rate. Revenue, earnings are going to have to grow really well. We're going to have to see expanding margins for this to happen. And this is the background that I see where that becomes challenging is, like you said, rehab, remodel, house flipping, where you may put on a deck to up the price on this house. That business, it's just not happening as much right now for the simple fact that financing costs are way, way up. We've talked a lot in previous videos about the rise in interest rates has basically seized up the housing market in the United States. Like existing home sales is falling through the floor because we have high interest rates. And the same thing applies to like the rent and remodel, or to the remodel and rehabilitation market, where right now the cost of capital for somebody to do this is much, much higher. We checked up just before we did this video, but the current rate for a home equity line of credit, HELOC, right now is 8.5%. A few years ago, we were talking down in the 3 to 4% range.
It is a pretty substantial 5-digit cost.
Yeah.
Most people aren't just going to write a check for that. They are going to finance.
Exactly. And so with financing involved, it's just more expensive. It's going to be harder for people to justify doing it. And so with that in mind, I question if like its historical growth rates can be applied to today. If I have a slowing market and I understand the stock is way down from where it was, at 35 times forward earnings estimates, or what a current last 12-month estimate of 53, you have to bake in a lot of optimism into how this thing is going to grow. And maybe on a company that's going to grow 15, 20% a year, great. I don't know if I'm going to get there with composite decking.
I'm going to push back on that, and I'm going to bring in the optimistic side a little bit, and I'm going to explain. I followed Trex for about a dozen years, so I'm going to explain how you can get from that 35 times forward earnings to potentially a growth rate that does make sense, and maybe the valuation isn't quite as expensive as it seems. First of all, the long tail is certainly growth because more consumers are choosing composite decking over traditional wood, so it continues to take market share. Trex is by far the industry leader. They have well over half of the market share, and they continue to take more market share every single year because they have national distribution. They have great relationships, not just in the Home Depots and the Lowe's, but regional distributors that work closely with contractors. They have great relationships there that kind of gives them a really big top of the funnel that I think is really valuable at customer acquisition. I do believe they will continue to grow faster than the industry. They've proven that they can do that. And the brand equity is really powerful for them. All right. There are concerns about the housing market. And if you look at the revenues actually fell the first couple quarters of the year and probably going to fall again in the third quarter, maybe the fourth quarter. We'll see. Things started to slow in the fourth quarter last year, so they might turn back to growth in the fourth quarter. Those cycles happen. That's a normal part of any company that provides something that's really heavily tied to the housing industry. Historically, what we've also seen happen is that when housing sales do go through a decline period and people maybe don't have the access to buy the house they want, they do tend to spend more money on the house that they have. So I think that those dynamics still could play in Trex's favor going forward. In terms of growth rates, I think realistically, investors should probably expect mid to high single digit revenue growth. This is a company that you go back to the end of 2019, before all of kind of the weirdness that's happened during COVID with housing and where we are now, revenue's up about 30% from that period. The stock's up about 50%. So there's a little bit of, hey, the stock's already gotten ahead of where it should be over the past 3.5 years just based on revenue growth. But what Trex has historically been able to do, Tyler, is take incremental revenue growth and turn it into higher incremental operating margin. They've been really good at that over time. Right now, we're in a down part of that cycle because, again, the revenue is down, so they've lost some operating leverage, but they're also expanding their manufacturing capacity. They're being methodical about how they expand it. But what's happening is as they start rolling on new manufacturing lines, they're adding operating cost ahead of the revenue that those facilities are going to generate. So their operating margins right now was less than 22% last quarter. Historically, they've been closer to 26 to 28% operating margin. So as business starts to normalize and as their operating margin returns to that normal historical levels, the cash generative power of this business should kick in. And today's stock price at a normalized kind of mid-cycle valuation is going to look a lot cheaper. With that said, what we don't know is all of the things you were talking about of cost of capital for homeowners, how much it's going to cost now, because there's the dollar amount to buy it. And then there's how much that payment is for that HELOC or the credit card payment or the store credit account that you get. We don't know how much that's going to be a headwind. So I think maybe a good time to think about opening a starter position, but it's certainly not a time to be just going big into Trex. The market will give you opportunities. Over the past 10 years, it's fall 20, 30, 40%. At some point in the future, that's the opportunity to really buy a lot. Maybe not quite as expensive as it seems to Tyler, but it's one to be patient with and let the market give you an opportunity to buy more.